Stop everything you're doing right now. Close every other tab. Turn off the notifications. Because what happened last night while you were sleeping, what's happening right now this morning, January 14th, 2026, is going to be remembered as one of the most significant moments in financial history. And if you don't understand what's really driving this, if you believe the story the mainstream media is feeding you, you're going to miss the biggest wealth transfer opportunity of your lifetime. My name is William Lee. I'm 33 years old. And I'm about to reveal to you something that nobody else is talking about, something the financial media is deliberately hiding from you, something so important that when you understand it, your entire approach to protecting your wealth will change forever. Right now, as I'm recording this on the morning of January 14th, 2026, silver is trading at approximately $90 per ounce. Let me repeat that, $90 per ounce. And it's heading straight toward $100. But here's what they're not telling you on CNBC. Here's what Bloomberg is conveniently ignoring. Here's what the Wall Street Journal isn't reporting. While you were sleeping last night during the Asian trading session, something extraordinary happened. Billions upon billions of dollars flooded into the silver market. Not millions, billions. The volume was unlike anything we've seen in modern history. Japanese buyers and Chinese buyers were fighting each other, literally competing for the same metal, trying to get in at the best price before it ran away from them. And here's what you need to understand. This is not a spike. This is not a bubble. This is not going to reverse. Silver is never coming back to $80. We crossed a threshold last night that cannot be uncrossed. What we're witnessing is historic. What we're witnessing is the beginning of a repricing so violent, so fundamental, that everything you thought you knew about money is about to change. But before I reveal exactly what's driving this, before I show you the Supreme Court case that nobody is connecting to silver, before I explain why the US Treasury might be forced to come up with $200 billion it doesn't have, I want to do something different. I want to hear from you because I love having a good relationship with my audience. I love knowing who's watching, who's paying attention, who's taking this information seriously. So please do me a favor, go down to the comments right now and tell me two things. First, where are you watching from? What city? What country? Second, do you have a question about what's happening? Drop it in the comments. I read every single one. All right, now let me get into what's actually happening, because what I'm about to explain to you, you will not hear this anywhere else. Not on financial television, not in the newspapers, not from your financial advisor. This is information that the establishment does not want you to have. Let me be straight with you from the start. I'm a private commodities analyst. I've been stacking physical silver for 12 years, and I'm here to give you the real-time picture, not the sanitized version you get from the evening news, but the raw truth about what's actually moving these markets. Silver just crossed $90. That's not just an all-time high. That's a psychological barrier being shattered in real time. Gold is over $4,600. And if you've been watching the financial media today, they're telling you this is about electric vehicles. They're telling you it's solar panel demand. They're telling you it's a healthy industrial bull market. I'm here to tell you something completely different. And I need you to pay very close attention, because what's actually driving this move could reshape your entire approach to portfolio protection. This isn't about solar panels. This is about a potential Supreme Court decision that could create a $200 billion obligation for the US Treasury. And if that sounds dramatic, good. Because the math is dramatic, the implications are dramatic, and the fact that most people aren't connecting these dots yet. That's exactly why I'm recording this right now. Here's what I'm going to walk you through today. First, I'll explain the Supreme Court case that is sitting on the docket right now and why it matters to anyone holding dollars. Second, I'll break down what I'm calling the fiscal flight to quality mechanism. Third, I'll show you the actual numbers from last night's Asian session, including some very strange price gaps between Eastern and Western markets. Fourth, I'll address the skeptics. And finally, I'll tell you exactly what I'm watching and what my personal plan is. This is moving fast. Faster than I've ever seen in 12 years of tracking this market. So let's get into it. The case at the center of all of this involves Trump-era tariffs. Specifically, tariffs that were imposed between 2017 and 2020 on hundreds of billions of dollars worth of imported goods, primarily from China, but also from Europe and other trading partners. The legal challenge argues that these tariffs were implemented without proper congressional authorization, violating the constitutional separation of powers. Now, you might be thinking, okay, so what? Tariffs get challenged all the time. And you'd be right, but here's where it gets interesting. If the Supreme Court rules that these tariffs were unconstitutional, the legal remedy isn't just stopping future tariffs, the remedy is refunds. Complete refunds to every importer who paid those tariffs over a multi-year period. We're talking about companies that paid tens of millions, in some cases hundreds of millions of dollars, in what would retroactively become illegal taxes. And under US constitutional law, when the government collects money illegally, they have to give it back. with interest. The estimates on the total liability vary, but the consensus among legal analysts I've been following puts it somewhere between $180 billion and $220 billion. Let's call it $200 billion. That's the number I'm working with. That's the number that's about to blow up the fiscal situation. Now, $200 billion is not a small number even for the US government. But here's the critical piece that most people miss. It's not about whether the Treasury has $200 billion in some abstract sense. It's about the timing and the mechanism of payment. When a court issues a judgment like this, there are deadlines. There are legal requirements for how quickly refunds must be processed. This isn't discretionary spending. This isn't a budget item that can be spread out over years. Court-ordered refunds create immediate liquidity demands. And here's the problem. The Treasury doesn't just have $200 billion sitting in a checking account. That money has to come from somewhere. And there are only three places it can come from. Option 1, cut other spending. Politically impossible. You'd have to slash Medicare, Social Security, defense, things with massive constituencies that would revolt. Option 2, raise taxes. Also politically impossible and economically devastating. Which leaves option 3, issue new debt. The Treasury has to go to the bond market and borrow $200 billion that wasn't planned for. $200 billion on top of already massive deficits. $200 billion that has to be absorbed by a market already showing stress. And that's where the precious metals market starts paying very close attention. Let me slow down and explain the mechanism because this is critical. When a government faces an unplanned, massive debt obligation, what we call a fiscal shock, something interesting happens in the minds of sophisticated investors. They start doing math. They start asking uncomfortable questions. The first question is, how is this going to be paid for? And the answer is almost always new debt issuance. The second question is, what does that do to the existing debt? What does it do to confidence in the currency? If the Treasury suddenly needs to issue $200 billion in new bonds into a market that wasn't expecting it, one of two things happens. Either they find buyers at current interest rates, or they have to offer higher interest rates to attract buyers. In a normal environment, the Treasury can usually find buyers. But we're not in a normal environment. We're in an environment where the 10-year Treasury yield has been climbing. We're in an environment where foreign central banks, particularly China, have been actively reducing their holdings of US debt. We're in an environment where the bond market is already showing signs of stress. So if the Treasury comes to market and says, we need another $200 billion fast, what happens? Either yields spike dramatically to attract buyers, or the Federal Reserve steps in and buys the bonds itself, which is just printing money. Both outcomes are poison for the dollar. If yields spike, the government's interest expense explodes. You're borrowing more just to pay interest on what you already borrowed. That's a death spiral. And if the Fed prints the money, you're directly devaluing the currency. You're increasing money supply without increasing goods and services. That's inflation. That's currency debasement. This is what I mean by fiscal flight to quality. When investors see this dynamic setting up, they don't wait for disaster. They move their capital proactively out of the currency and into assets that can't be printed, can't be debased, can't lose value through monetary policy. Historically, that's been gold. But increasingly, and this is what we're seeing right now, it's also silver. And here's why silver moves like a rocket when this happens. Market cap. The entire above-ground silver market is tiny compared to the bond market. It's tiny compared to the stock market. It's even tiny compared to gold. When the exit door out of the dollar gets crowded, when billions of institutional capital decides simultaneously they need hard assets, silver's door is smaller. Less supply, more violent price moves. Think of it like this. Imagine a bank realizes they've been overcharging customers for 5 years. A judge orders them to refund every penny by month's end. The bank doesn't have the cash. They have to borrow at whatever interest rate they can get. That whatever interest rate moment, that's the fiscal shock. And the customers who hear about this before the announcement, who start withdrawing deposits early, those are the people buying silver right now. That's the mechanism. Now let me show you what it looks like in practice. Last night during the Asian trading session, specifically between midnight and 6 a.m. US Eastern Time, silver absolutely exploded. The volume was staggering. Billions of dollars flowing into silver in hours, not the typical few hundred million, billions. Japanese buyers were competing with Chinese buyers for the same metal. And when I say competing, I mean a bidding war. Prices in Shanghai were running $8 to $10 above New York prices at points during the night. In normal markets, you get small premiums between regions. Shipping costs, local demand, maybe 1 to 2 difference. But 8 to 10 on a $90 asset, that's an 11% premium. That doesn't happen in a functioning market. What that tells you is that physical silver is being pulled out of Western vaults and shipped east as fast as it can be moved. When you see a price gap like that, what you're seeing is arbitrage. Traders buying in New York at $90, selling in Shanghai at $98, $99, pocketing the difference. But here's the problem. It only works as long as there's physical metal available to buy in New York. And when you're moving hundreds of millions of dollars based on an 8 to 10 gap, those vaults empty fast. I'm not saying we're at that point yet. But the gap is a massive stress indicator. It's telling you the physical market and paper market are starting to disconnect. And when that disconnect persists for more than a day or two, you get into dangerous territory where the Western price becomes irrelevant because there's no metal available at that price. This morning, silver spot price and the official COMEX price is approximately $90 per ounce. All-time high, gold is over $4,600. But here's what you can't see unless you're watching carefully. The Shanghai Gold Exchange was showing silver prices equivalent to $98.99 per ounce when you convert yuan to dollars. New York, $90. Shanghai, $98.99. That's an $8.90 premium. On a $90 asset, that's roughly 10%. That doesn't happen in a healthy market. That's severe stress. That's a system breaking down. The fact that the gap isn't closing, it's been persistent for over 24 hours, tells you one of two things. Either there isn't enough physical silver in Western vaults to make arbitrage work at scale, or traders expect the Western price to rise to meet the Eastern price. Either scenario is extremely bullish. Either scenario suggests we're in early stages of a breakdown in the paper pricing mechanism. The other number I'm watching closely is the US dollar index. The DXY this morning is relatively stable. It's not showing the collapse you'd expect if the dollar was in crisis. And that's important because it tells you the mainstream market hasn't priced this in yet. The bond market is operating as if everything is normal. But the silver market isn't. Silver is vertical, and that divergence, that gap between what silver is doing and what the dollar index is doing, that's your early warning signal. That's the canary in the coal mine telling you that smart money is positioning for something the mainstream hasn't figured out yet. Now let me address the demand story, because this is what you're hearing everywhere else. The narrative is that silver is rising because of industrial demand. Electric vehicles need silver. Solar panels need silver. Green energy transition. All of that is true. Industrial demand for silver has been growing, but let me give you context. Annual industrial demand is around 600 million ounces, about half of total demand. The other half is investment and jewelry. If this move was purely about industrial demand, you'd expect gradual development over months or years as factories ramp up. What you wouldn't expect is a 12% vertical move in 48 hours. That's not how industrial demand works. Industrial buyers plan purchases months ahead. They hedge. They lock in prices with long-term contracts. They don't panic buy at all-time highs. What creates 10 to 12% moves in 2 days? Financial flows, investment demand, people moving massive capital out of one asset class into another because they're worried about what they're leaving. So when I see silver up this dramatically, this fast, and I know there's a $200 billion fiscal shock potentially coming, and I see an $8 to $9 premium in Shanghai that won't close, I don't think solar panels. I think currency hedge. I think flight to safety. I think smart money positioning ahead of crisis. Let me show you the math on what a $200 billion Treasury obligation means. The current U.S. national debt is approximately $36 trillion. Annual interest expense at current yields is around $1 trillion per year. Just interest, not paying down principal. If the Treasury issues $200 billion in new debt to comply with this refund order at a 5% yield, that's $10 billion per year in additional interest expense forever. But here's the compounding effect. The bond market isn't stupid. When they see a surprise $200 billion issuance, they'll demand higher yields to compensate for increased risk. Maybe 5.2%, maybe 5.5%, maybe more. And as old bonds mature and get rolled over into new bonds at current rates, the interest expense on the entire debt stock gradually increases. If this pushes yields up even 0.5%, you're looking at an additional $180 billion per year in interest expense across the entire $36 trillion as it rolls over. $180 billion per year. Every year, forever, until rates come down. And how do rates come down? Either the economy collapses so badly the Fed cuts to zero, or inflation gets so bad they have to hike even higher. Neither scenario is good for the dollar. This is the death spiral. Fiscal shock creates higher borrowing costs. Higher costs create more debt. More debt creates even higher costs. And somewhere in that spiral, investors lose confidence in the currency's ability to hold value. That's when they buy silver. Now let me stress test the Shanghai scenario because this is the more immediate risk. If the 8 to 9 premium stays open another 48 hours, you're going to see massive physical flows out of Western vaults. London vaults hold around 1 billion ounces of silver. That sounds like a lot, but when you're moving metal at this scale, it's not infinite. If arbitrage stays open, you could see 100 million ounces or more move in a week. And if the market suspects London is running low, that's when you get a force majeure event. That's when the exchange says, sorry, we can't deliver physical at paper price. Settlement will be cash or delayed. Once that happens, once paper and physical markets decouple completely, The paper price becomes meaningless. The only price that matters is physical, and that price is set by whoever has metal and whoever is desperate enough to pay for it. Let me address the skeptics. First objection: the $200 billion refund will take years. This is slow-moving, not immediate crisis. I understand that perspective. Government moves slowly. Legal processes take time. But here's what you're missing. Markets are forward-looking. They don't wait for disaster to happen before pricing it in. The moment the Supreme Court rules, the market prices in the eventual $200 billion immediately. That day, that hour. Liquidity doesn't drain slowly. Confidence doesn't erode gradually. These things happen in seconds. When trillion-dollar institutions decide Treasury bonds are riskier than they thought, they start reducing positions. And when they sell, yields move fast, violently fast. Second skeptical argument: high yields kill silver. The logic is when rates are high, people prefer bonds with guaranteed returns over silver, which pays no yield. In normal times, that makes sense, but we're potentially entering a fiscal crisis. In a crisis, high yields don't represent competitive returns. They represent default risk. Why do yields go up? Because buyers demand more compensation for risk. When the Treasury offers 5%, it's because the market says we need 5% to make the risk worth it. When yields spike to 6%, 7%, 8%, that's not opportunity, that's warning. That's the market saying, we think there's real chance you can't pay this back. When the bond market is on fire, you don't stay in the burning building because the yield is attractive. You get out. And historically, where do you go? Hard assets, gold, silver, things that can't default. Third skeptical argument: the dollar index isn't collapsing, so how can this be a dollar crisis? The dollar index measures the dollar against other fiat currencies: euro, yen, pound. And all of those currencies have their own massive problems. Europe has debt crisis brewing. Japan has fought deflation for 30 years. The UK had a bond market crisis in 2022. So when the dollar index stays flat, it doesn't mean the dollar is strong absolutely. It means it's less weak than other weak currencies. It's relative, not absolute. Silver is an absolute measure. Silver doesn't have a central bank that can print more. Silver is silver, fixed quantities. When silver is going vertical and dollar index is flat, that tells you the problem is systemic. All fiat currencies are weak relative to hard assets, and smart money is figuring that out first. Now let me tell you what I'm watching. My triggers, my personal battle plan. This is not advice. This is what I'm doing based on my own risk tolerance and capital situation. First trigger: Shanghai premium. Right now, $8 to $9. If it crosses $12 and stays there 24 hours, that tells me physical shortage is critical. At $12, you're looking at 13-14% premium that can't be explained by normal dynamics. That's a signal Western price is becoming irrelevant. If I see $12 and hold, I'll be very cautious about assuming I can buy physical at paper price. I might start paying premiums to lock in inventory. Second trigger: US 10-year yield. Right now, around 5%. If it crosses 5.5% and holds, that signal the bond market is breaking. That signal buyers demand significantly more compensation for risk. If yield goes to 5.5% while this Supreme Court decision is pending or just announced, that tells me market is pricing worst case. That's when I think seriously about moving more capital into physical assets. Third trigger: government response. If the court rules against tariffs and government announces a stay or delay on implementation, that relieves immediate pressure. It gives Treasury time to plan. If that happens, I expect silver to pull back significantly, maybe to $75 to $80 as immediate panic subsides. I'd look for re-entry points at better prices, but if court rules and there's no stay, immediate implementation with hard deadlines, that's when things get very interesting very quickly. My personal positioning: I'm not chasing this vertical move with new paper positions. The move has happened. We're at $90 heading to $100. Risk reward of buying here doesn't appeal for new positions. But I own physical silver. I've been stacking 12 years, so I'm sitting on gains. My concern is not how do I get more exposure, but how do I protect the exposure I have? If silver hits $95 today or tomorrow, I'm looking at buying put options on SLV as a hedge, not because I think silver crashes, but because there's real risk of margin hike-induced sell-off that could take us back down 10-15s quickly. When markets get this vertical, exchanges often intervene with margin hikes to cool things down. That can create violent temporary sell-offs. If that happens, I want to be hedged. I want to make money on downside to offset temporary paper losses on physical holdings. Then if we get that sell-off, I close puts for profit and use that to buy more physical at lower prices. That's how I'm thinking about near-term volatility. My second trigger is the 10-year yield. If it crosses 5.5%, I'm moving liquid cash into physical metal regardless of premium, because if the bond market is signaling liquidity crisis, premium doesn't matter. What matters is having the metal, not being stuck holding cash or bonds when everyone realizes they want something else. All right, let me bring this home. We are witnessing something historic. What happened last night in Asian markets? Billions flooding into silver, Japanese and Chinese buyers fighting for the same metal, prices in Shanghai running 8 to 9s above New York. This is not normal. Silver is at $90 heading toward $100. And I'm telling you with confidence, we're not going back to $80. That threshold is behind us. What we're witnessing is the beginning of a repricing so fundamental that old assumptions don't apply. The Supreme Court case, the $200 billion fiscal shock, the Shanghai premium, the bond market stress, these aren't separate stories. They're all connected. They're all part of the same picture. A government facing a cash crunch it wasn't planning for. A bond market starting to demand higher compensation for risk, and smart money moving out of paper into hard assets before the crowd figures it out. The mainstream narrative wants you to believe this is about solar panels and electric vehicles, and maybe there's some truth to that, but it's not the main story. The main story is fiscal stress. Governments have borrowed more than they can realistically pay back without debasing currencies, and the people who see that, who understand we're one court decision, one fiscal shock, one liquidity crisis away from repricing everything, they're not waiting for CNBC to confirm it. They're acting now. They're buying silver at $90 because they know it's going to $100, $150, maybe $200. Don't be exit liquidity for the banks. Don't be the person who figures this out after everyone else is positioned. Pay attention to what the market is doing, not what the media says it's doing. This is William Lee. I've shown you the Supreme Court case. I've explained the fiscal mechanism. I've given you numbers from last night's Asian session. I've shown you my triggers and personal plan. Now you need to build your own map. And remember what I asked at the beginning. Drop a comment. Tell me where you're watching from. Ask me a question. I read every comment. Stay sharp. Watch the indicators. And whatever you do, don't believe the solar panel story. This is about money. This is about currencies. This is about the biggest repricing event of your lifetime happening right now. We'll see $100 silver very soon, possibly this week. And when we do, remember you heard it here first.